Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment at the MarketSite studio, we have Phil Mackintosh, chief economist at Nasdaq. We're going to take a look at inflation data, which is actually starting to come in a bit. Phil, it's great to see you as always. Welcome back to Trade Talks, and let's quickly get a weekly review of how the markets have been responding to all the data that's been coming out.
Yeah, I mean, a little bit all over the place because some of the data's been good and some of the data's been bad. But I mean, inflation is the thing that came out that I think everyone was watching for and waiting for, and it came down pretty significantly again, which is great news. So that means that the Fed theoretically can start to take their foot off the gas.
And let's take a look at your next chart here where we can see that inflation data more specifically and the different areas where it is in fact coming down.
Yeah, so pretty much everywhere. So with all of the war inflation that we talked about, the food and energy costs are starting to come down. Obviously, prices of gas at the pump are much lower, but also some of the goods, like the manufactured goods, are starting to get cheaper as well because the supply chain has eased. Really, the only thing that's still holding inflation up, if you sort of look at the breakdown, is rent. And if you look at some of the prices of houses, they're starting to fall now too. So the expectation is not only has the top line inflation, which is the orange line there, been coming down for months, but it should continue to come down.
And that's why we saw the positive reaction with the inflation data earlier this week, because in theory, does that mean that the Fed could stop raising rates?
That's the theory. I mean, the whole reason the Fed is raising rates is to slow the economy, fix the supply-demand imbalance so that the prices stop going up. The fact that prices are coming down means the Fed probably can start to think about pausing, stopping raising rates.
Right, and the next question is, by how much are they going to continue raising rates, 50 bips or 25?
Right, and so if you look at when they stop completely, which is the chart we've got here, what's interesting is usually once they stop, the market starts to rally. So that's the good news. I think the question about whether the Fed actually stops straight away, and the market's pricing in another 50 basis points worth of hikes. What was interesting was the Fed was talking about maybe 3 more 25 basis point hikes. So the Fed's kind of going past where the market thinks the Fed's going to need to go.
Well, uncertainty still does remain, right? And really what the question is, we can talk about macro all day long. We can talk about how we think the Fed is going to shift in policy. It really is anyone's guess. But earnings forecasts, I feel like that's the next shoe to drop to kind of hit that capitulation point because they haven't come in, these forecasts.
Yep, and consumer spending hasn't really stopped and unemployment hasn't really turned around. So that's one of the problems the Fed's got, and I think it's why the Fed's saying, yeah, we might get to 5.25, not 5. The market's saying 5 is probably what we need to do for a soft landing. The Fed's kind of overshooting at the moment, and they almost have to. While employment is so strong, while spending is so strong, inflation doesn't look like it's going to come down fast enough to sort of slow the Fed down by March, April-ish.
Right.
And so then you run the risk of the corporates really struggle with margins and really struggle with earnings, and that could actually cause the market to have a bit of another sort of reality check.
I mean, you're starting to see cash deteriorate on the balance sheets already, right? And the capital picture looks a little bit different, but in terms of the market, the Fed makes its rate decisions 4 times in the beginning of the year. You have that break kind of over the summer, and then you have the last 4 meetings of the year. Does it make sense for them to do a quarter hike each one, and then they can stop and take a look back and see how the policy is working? Or not?
I mean, I guess where we started was so low.
Right.
So if you look at sort of GDP growth and the population growth, probably 2.5% is about like normal or neutral rates. So we had to kind of get to that level pretty quickly, and that's what they tried to do. Now that we're at 4.5, we're definitely above that level, so that should be contractionary. And that's what the Fed's sort of saying is, if we might need to go a little bit slower just so we don't accidentally cause a recession, because the data is lagging on what we're doing with the rates. And so they are talking about slowing down. The question is, where will they stop? And to your point, has the corporate side and even the household side started running out of money already?
All right. Appreciate the insight as always, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.